Hey everybody, how are you? Hope you are well. So today we're going to talk about the HSA. What is the HSA? But before I do that, I want to talk about the stock market real quick. If you are afraid to invest in the stock market, I want you to check out the book of the month that I have. You'll see it down below. And I want you to read that book if you're afraid to invest in the stock market, or if you have thoughts like, I don't play with the stock market, then you need to read this book, and it will be listed below because you should have been in the stock market 20 years ago. All right. So check out the book of the month and read that book. All right. HSA. The HSA, what is that? So it's a health savings account. It is offered by some employers. And if you see that this is offered and you work at a company that offers it, it's a good idea to take advantage of it. Um, what it does is it's a tax advantage account. And how it operates is you can take deductible contributions, you can take tax-free withdrawals to cover medical expenses. So you can take money out to cover medical expenses. And then you have tax savings going in. You have tax savings going in. This is your HSA. So you have tax savings going in and you have tax savings going out, meaning that if you need to withdraw from it for medical expenses, it can only be for medical expenses, then there are no penalty for that, for taking the money out. So the advantage of being in the HSA, if it's offered to you, is that you're paying less. You're paying less taxes. So say, for example, you have $50,000. This is just an example. Say you have $50,000 and you put 3,600 into this HSA. So how that's going to work with your taxes is instead of being taxed on the $50,000, you're going to be taxed on $50,000 minus the 3,600 you put in. So you're going to be taxed on 46,400 instead of being taxed on the $50,000 that you made. So that is the benefit of having some money in the HSA, is that you are paying less taxes on your money. Also, your money is in there, it's growing and it's compounding, tax free. This is called a tax advantage account. And so the IRS, they just recently changed the limit on it. So in 2023, if you were single, the max you could put in was $3,850. If you were a couple in 2023, the max you could put in is $7,750. So the IRS has increased this limit to $10,000 a year if you're a couple. So for couples, the max you could put in is $10,000 a year. So this goes up every year. In 2022, if you're single, the max you could put in is $3,650. Then it went up in 2023 as a single. The max you could put in is $3,850. In 2022, as a couple, the max you could put in is $7,300. And then it went up in 2023 as a couple. The max you could put in is $7,750. So the new rule is that if you are a couple, the limit has increased and the max you could put in is $10,000 a year. So if you work at a place that has the HSA, um, just take a look at it. So what happens is your employer can put money in, and then you could also put money in. but you can only put in up to the limit. So, say for example, you're a couple and the limit is 10,000K a year now. So, say if your employer puts in 5,000, then you can only put in 5,000 because you can't go above the limit that is set. And the current limit is 10,000 a year for couples. So they also have what is called a catch-up contribution. Catch-up contribution. So if you're 55 or older, you can add an additional $1,000 to whatever the limit is. This is the catch-up contribution. So money can be withdrawn penalty-free for medical expenses only. However, when you reach the age of 65, after the age of 65, you can withdraw money penalty free for any purpose, not just medical. This is after you have reached the age of 65. So it has its own rules that goes with the HSA. Age 65 distributions. Okay, starting at the age of 65, that's when they're going to start taxing the money. So you're getting all these benefits now. It's growing, it's growing, it's growing tax free, it's growing tax free. You can put the money in tax free. You can take the money out tax free if it's for medical expenses. It's growing tax free, it's growing tax free, it's growing tax free, it's growing tax free. Then you hit age 65. So at the age of 65, whatever you have not used for medical expenses, it will be taxed. And it's going to be taxed just like the 401k or the traditional IRA. So it's kind of like it's not being taxed now. It's a tax advantage now. And it's growing, it's tax free, it's growing, it's growing, it's growing, 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 growing. You're not being taxed on all the money you make. But then now you're 65. Now the rules change. So you're not being taxed now, but later on down the road, tax. So this is the HSA. Just to familiarize you with the HSA, if you're not already familiar, it's the health savings account, and if you're at a company that offers these different kinds of tax advantage accounts, it's a good idea to take advantage of them. There are a lot of accounts available. If you're with an employer that has a 401k, are you in the 401k? I mean, some they match your 401k. So if you're not in it, you're missing out on free money. So there's the HSA, the 401k, the Roth IRA. Are you in any of those things? So if not, just think about it. Think about the benefits, and then think about what's going to happen down the road. Some prefer not to be in these types of accounts. Like you'll hear people talking against the 401k, for example, because they know at the end they're going to be taxed at the very end. But it's actually to be taxed. It's better to be taxed. Okay, let me give you a scenario. Would you rather get to the end and you have a lump sum of money? Would you rather be taxed on this lump sum of money and your lump sum is a little smaller than you expected? Or would you rather not be a part of any of this and you haven't saved anything? So when you get to the end, you haven't saved anything. You haven't saved anything. You haven't bought any real estate. Um, you haven't started any businesses. Would you rather that to happen? Or would you rather be in some kind of account at the end? It's going to be taxed and it's a little smaller than you expected. So that's what happens with the 401k. It also happens with the HSA. Um, People don't have problems with the Roth IRA because at the end, the Roth IRA is not taxed. So some people just prefer to put all their money in the Roth IRA because they know that's not going to be taxed at the end. So, but it is a good idea to diversify, you know, diversification. All right. So if you like the channel, please hit the like button. If you're not a subscriber, please hit the subscribe button and notification bell next to it so that you won't miss the episode. Also, leave a comment. Let me know your thoughts. Also, back to the stock market that I was talking about earlier. If you're not in the stock market, if you are afraid to invest, if you don't trust the stock market, um, what other reasons would you not be in the stock market? You don't play with the stock market. I hear that. What other reasons would you not be in the stock market? Um, you're just not familiar with it because it's not taught in school. Um, what other reason would you not be in there? Mm, I would say just a general mistrust. If any of that is you, I have a course and I would like for you to check it out. It will be below because it's time for you to join the wealthy. Time for you to join the wealthy. If you talk to anyone who is wealthy, ask them what do they think about the stock market, and then come back to me and tell me what they said in the comments. All right. Thank you for watching. Before you leave, hit the like button on your way out. If you received any value today, please hit the like button. If you're not a subscriber, hit the subscribe button and notification bell next to it so that you will not miss an episode. Thank you for watching. Have a good rest of your day.